The Startup Ascent. Navigating the path from idea to early traction. The journey from a mere concept to a company with demonstrable early traction is foundational. While often characterized by dynamism and uncertainty, this early phase benefits immensely from a methodical approach to validation, team building, and resource acquisition. Successfully navigating these initial stages, pre-seed, seed, and Series A, lays the critical groundwork for subsequent hypergrowth. The crucial early stages, pre-seed, seed, and Series A. The life cycle of a startup typically progresses through distinct funding and development stages, each with its own objectives, challenges, and investor expectations. Pre-seed stage, this initial holders, such as a technical co-founder or early advisors. Funding at this juncture, typically ranging from $50,000 to $500,000, often originates from the founder's personal capital, friends, and family. This underscores the profound personal risk and conviction required. The emphasis on validating hypotheses suggests that even before significant capital is raised, founders must adopt a researcher's mindset. The failure to rigorously validate assumptions at this stage is a primary contributor to the high startup failure rate, as it can lead to investing resources in building something for which there is no genuine market need. Therefore, pre-seed resources should be heavily allocated towards customer discovery and market research, with the goal of producing a strong, evidence-based case for the venture's viability. 2. Seed stage. Following pre-seed, the seed stage is where the validated idea begins to transform into a functioning business. A core activity is the development and testing of a minimum viable product, MVP. This MVP is subjected to initial marketing strategies and tested in different market segments to gather crucial feedback and make the product and operations more tangible. The overarching goal is to validate the entire business model and achieve product market fit, PMF, which Y Combinator describes as making something users genuinely love. Funding sources diversify at this stage, including early revenue, angel investors, crowdfunding platforms, and accelerator programs. Seed rounds typically raise between $500,000 and $2 million, with a median of $3.5 million and a median pre-money valuation of $14.8 million as of Q1 2024. Due to the continued high risk, investors expect an equity stake in the company. Key objectives extend beyond MVP development to include hiring for critical roles and conducting further market research to refine PMF. The seed stage acts as a crucial filter. Success in securing subsequent Series A funding hinges on demonstrating not just an MVP, but an MVP that generates compelling early traction, e.g., user growth, engagement, and showcases the founding team's ability to learn and iterate rapidly based on market feedback. This learning velocity is a key signal to Series A investors. Series A stage, early stage. Successfully navigating the seed stage leads to Series A, which typically marks the first significant institutional investment in a startup, predominantly from venture capital firms. The primary objective of Series A funding is to scale a business that has already demonstrated a proven business model and initial market traction. Capital raised, usually in the range of $2 million to $15 million, with an average of $16.6 million in January 2025 and a median pre-money valuation around $40 million in Q2 2024, is deployed to increase market share, enhance product features, build out a larger, more specialized team, and optimize operations. Investors at this stage look for a clear path to long-term profitability and evidence that the company can generate revenue sustainably. Founders preparing for a Series A round must demonstrate significant progress. This includes having a runway of 12-18 months, a compelling narrative that clearly articulates the problem, the unique solution, and the market capture strategy, supported by robust data. A concise and persuasive pitch deck, typically 15-20 slides, is essential, covering elements such as company purpose, problem definition, solution, timeliness, why now, a market potential, competitive analysis, business model, and the strength of the team. Early networking with potential investors, 6 to 12 months prior to actively fundraising, and meticulous preparation of documentation, including financial statements, key performance indicators, KPIs, product roadmaps, market analyses, and intellectual property verification are critical for a successful Series A process. The transition from seed to Series A signifies a shift in investor focus from primarily product risk to execution risk. While PMF should be largely established, Series A investors are critically assessing the team's capability to build a scalable organization, manage a larger budget effectively, and execute a complex growth plan. The scalability of the founders themselves comes under scrutiny, demanding they demonstrate leadership potential beyond early-stage hustle.